This is the Asia Trade. I'm Haidi Stroud-Watts in Sydney.
And I'm Paul Allen. The top stories this hour. Asian markets set for a cautious start to the week with rate expectations in play for bond traders. China's activity data out later expected to confirm the economy lost momentum last month as credit demand weakens.
Tech and AI in focus as Bloomberg learns that Anthropic's second quarter revenue surged above $11 billion ahead of its potential mega IPO.
And fresh Israeli strikes on Lebanon set to further complicate stalled Middle East talks as Washington prepares a plan for economic isolation of Iran.
Let's get you straight to the setup when it comes to trading across Asia this Monday morning, and it is geopolitics in the fray. We had quite a bit of rhetoric in terms of what exactly is President Trump and Washington's plan when it comes to this next step with the war with Iran, right? We are seeing a pretty steady picture when it comes to trading in oil prices. In fact, New York traded crude at the moment essentially flat. We had Brent crude last trading higher by about 0.25%. So steady as she goes, despite fresh fighting in Lebanon, attacks on vessels in the Strait of Hormuz, all of this a very muddied outlook to how we potentially get to the end of this conflict. But take a look at what we're watching in terms of some of the other asset classes that will be in focus. We do have a number of key CPI prints this week, including for Japan. We'll be watching the yen. 159.18 is where we're trading. We did see the dollar really consolidating against some major pairs in the early part of the morning trade, Paul.
Well, let's set up the trading day with our team. Bloomberg MLive strategist Mark Cranfield joins us from Singapore. Also, markets reporter Anthony Stevens is in Hong Kong. Mark, one thing we didn't mention, there's going to be a very important bond auction in the US this week, a 20-year note auction, $16 billion, following on from last year's interesting 10 and 30-year auctions. What can we anticipate here? Are bonds not offering that much of a cushion to markets at the moment?
It's going to be a very difficult auction to get off the ground. Last week, the 10 and the 30s, they both came with the highest yields in many years, a couple of decades in some cases. So clearly there's not a great appetite for long-term bonds in the US market at all. In fact, that's globally the case, really. And then 20-year itself is a particularly unloved part of the curve. It falls between 20 and 30, which are the popular sectors. So it's neither here nor there. So typically it's always a bit of a struggle. This week is going to be even more difficult. Just last week, we had the US budget deficit came in at over $400 billion, more than 25% worse than expected. Those numbers are just unsustainable. Investors can see that you have a US government which is overspending, even when the US economy is pretty strong. If we were in a recession, people might forgive those kind of numbers. They might say they're pumping money to get the economy back on its feet. That is not the case. The US economy is doing fine, and inflation is a bit sticky. Even though the numbers have come in line, the underlying core inflation is still around 2.5% in the US, which is way too high considering the time in the cycle. Investors can see all this. They can see the fiscal indiscipline. They can see that core inflation is too high, and they're probably thinking that the Federal Reserve made a huge mistake by lowering interest rates last year. At the moment, we're only pricing for about one interest rate hike this year. That could easily shift depending on the data that comes out in the next couple of weeks. Clearly, the situation is very nervous for long-term investors. They do not see global central banks, let alone the Federal Reserve, doing anything to rein in long-term inflation. So they're taking the job into their own hands. They're pushing up the yield curve, asking for a higher term premium, and that's going to make this week's 20-year auction particularly difficult in the US.
Anthony, when it comes to the broader kind of risk and volatility gauges, everything's feeling quite calm at the moment. I'm going to touch wood because I feel like we shouldn't be saying that too loudly. But what's a potential downside here? Is the sort of China macro picture? We've talked a little bit about the credit numbers. We know that the activity data this week probably won't be that good either. Is that a broader investor problem, or is that really more of just a China macro problem?
You do see this like insulation of the tech trade from almost anything else that's going on, right? And that is the context to some of the headlines that you were mentioning right at the top of the show with regards to Anthropic, for example, right? Those are insane numbers. It's double last quarter already. And then you had the 13F filings highlighting just how much money people like Nvidia or Google made in the SpaceX IPO or the Cerebras IPO. So that kind of capital flywheel in the tech space is doing really well and is quite insulated from broader macro concerns. Credit spreads in the US are also relatively tight, and the VIX is relatively low. So in terms of taking incremental tech risk, there is not a lot of gremlins around. But in terms of the broader macro picture, yes, the Chinese story is a lot weaker than anticipated at the start of the year. Credit demand is quite bad, retail sales are quite bad, growth is quite bad outside the export and AI story. So once again, even in China, AI remains an idiosyncratic risk to the upside versus a kind of broadening out of the weakness on the downside in the rest of the economy. And that's kind of similar to what you saw in the US as well. We saw retail sales miss quite badly. Now wages are underneath CPI at a headline level. So wages are your net losing money every month, and that's been going for a couple of months. So this dispersion between the broader macro and the AI story is very, very strong at the moment, and investors are leaning into it. They're putting all their chips on the table in AI and taking money off everything else.
Mark, I want to get your view on that as well in terms of concentration risk. How are we seeing this appear more broadly?
Yeah, I think if you look, for example, you take the Euro-Swiss franc exchange rate. It's usually a typical hedge when there's a macro event going on in the world. We saw in March when the US-Iran war started. As usual, macro investors dived into Euro-Swiss, selling the euro, buying the Swiss franc. It went down dramatically, in line with equity markets. That's massively rebounded. Now Euro-Swiss is sitting higher than it was at the beginning of the year. That pretty much tells you, as Anthony is suggesting there, is that people don't really want to hedge the risks of another major event in markets. They've seen one big one this year. They don't think there's going to be another one for a long time. They're getting pretty comfortable. They just want to throw money into the biggest parts of risk-taking they can in the markets, in the equity space, whether it's tech, AI related, whether it's corporate bonds. For now, they're not willing to bet a huge amount of money on the chances there's going to be another major event to derail that. The VIX index is also being distorted by the fact that there are a number of huge funds which are selling volatility as part of a strategy and selling that to clients. If you have this continuous offer in the volatility space, the VIX is bound to stay low. You can see that play out across markets, whether it's in currencies, whether it's in bonds, equities, the whole gamut here. Volatility selling has become a core theme of investment strategies. It needs a major blow up for that to change. People don't think there's one on the horizon for now. We could have this US-Iran tension going on indefinitely. In a way that will suit markets. They can deal with that. If oil stays in an $80, $100 range, they can price that in. That's not something they need to put right in front of them. They can still put it on the side and say, okay, we know oil prices are high, we can deal with it. Let's focus on the earnings potential and the potential for another amazing IPO. If Anthropic can do a $2 trillion IPO, which is the talk that some people had last week, that would really galvanize markets over the next few weeks leading into the autumn. So there are much more interesting things for people to focus on than the risk of another major event, which may or may not happen. It could be well off. We're not going to price that in for now when there's money to be made in short-term plays.
It's just such an extraordinary situation, right? And, Anthony, I think to Mark's point, looking at this story about how we're still seeing significant amounts of covert shipments through the Strait of Hormuz that perhaps we're not talking about, and that's why we're seeing this lid being kept on oil prices for now. I wanted to ask you about the other side of the inflation, the reflation story, though, because we've got CPI prints coming out from Japan, Canada, and the UK after the US readings last week, and chipflation is going to be front and centre, right? Is this going to be something that thematically starts to dominate multiple economies as the AI trade continues?
Yeah, it was interesting to read a lot of the analysis in the details of the weekend, right? It really depends on the weightage chips and kind of electronics make in the different CPI baskets. In the US, it's actually vanishingly small because it's offset by a price fall in, for example, software or gaming, stuff like this. So the implication of semiconductor pricing really depends on what economy you're talking about. And that's why Japan is going to be maybe slightly different from the US, where the basket weighting is higher. So that's an interesting way of looking at things. Also, in terms of an inflationary impact from the AI space, from the tech space, the capital crowding out impact in terms of treasuries or interest rates from the AI capital raising is also interesting, right? You see the amount of money that even second-tier players in the AI space are able to raise. For example, AMD raised a bond that is pretty much the size of a treasury auction, right? And it tightened and the stock is higher. So this demand for AI-related credit, for AI-related deals, for example, the Open Router deal is rumored to be in the range of $7 billion. You know, that kind of notional going into AI versus going into traditional kind of risk assets or risk-seeking assets is really putting pressure on stuff like treasuries, putting pressure on kind of inflation-linked assets, right? So this competition element to flows is also another important way of looking at the AI trade and how it impacts global rates and global inflation expectations.
All right, Bloomberg M Live strategist Mark Cranfield and our markets reporter Anthony Stevens, thank you both. Let's get to some other corporate stories that we're tracking. Bloomberg has learned that Jane Street posted roughly $15 billion of losses in July, the firm's first monthly slump in about a decade. According to sources, this was driven by wrong-way bets in Asian equity markets and its investment in AI-focused hedge funds, situational awareness. However, Jane Street has generated more than $40 billion of net trading revenue so far this year. That's more than it did in all of 2025. Alibaba says its AI models have accumulated more than 3 billion global downloads in the past 6 months, surpassing Meta and Google to become the world's #1 AI model. The company statement says Qian has open-sourced more than 460 models, and its ecosystem has spawned more than 300,000 derivatives. A Hugging Face report says Alibaba's AI models now have one of the largest foundations of the open-weight AI ecosystem. ZAI says its next-generation AI model will deliver a major upgrade in coding capabilities as Chinese developers race to challenge OpenAI and Anthropic. The company plans to release the model within 2 weeks and says benchmark scores show a significant improvement over its current system. Despite the announcement, ZAI shares slid in Hong Kong on Friday as investors took profits ahead of quarterly results.
Well, still to come in this hour, and deadly Israeli strikes on Lebanon set to further complicate deadlocked US-Iran negotiations. We have the details next. This is Bloomberg.
Lebanon has seen its deadliest day of Israeli attacks in months, heaping pressure on stalled US-Iran negotiations while Washington prepares fresh sanctions. For more, let's bring in Bloomberg senior editor Wendy Benjaminson. Wendy, it's a big day, the ceasefire expiring today. I mean, the question is, now what for this US-Iran conflict?
Yeah, well, you're right, Paul, that the ceasefire is technically over on Monday. The trouble is that Trump and Iran both sort of declared it dead a while back. So it's a marker that we're watching, but I don't think it's actually going to change much. Right now, we are in this weird stalemate paralysis where nothing is really moving. Iran and Oman supposedly are talking about a deal to administer the Strait of Hormuz, but Iran says the U.S. isn't a party to those talks, and Iran says that it'll have nothing to do with how they relate to the United States. The United States says they're not interested in talking, that they're going to unleash undefined economic pressure tactics on Iran. Treasury Secretary Scott Bessent says he'll announce those this week. And so you're absolutely right. I mean, we're in this weird sort of, holding pattern. But Israel, for its part, decided, is still attacking Iran's proxies like Hezbollah, while at the same time, Jared Kushner, the president's son-in-law, is in Egypt talking about Gaza. So there's a lot of related things going on, but nothing toward ending the war or lowering gas prices around the world.
In the meantime, what do we make of President Trump's new strategy? We heard about the sort of maximum pressure, economic pressure strategy last week. Is this still kind of the way forward, and is it likely to be effective, given we know how willing this Iranian regime is to just bunker down.
Well, you're absolutely right, Heidi. I mean, Iran has proven not only in the last 47 years, but across the centuries that they don't capitulate easily. And they are not a democracy. They're not answerable to the people of Iran. So yes, I mean, the economy of Iran is in rough shape. They've got inflation around 77%, I think was one of the latest figures. And, things are bad and thousands of people have died. But we don't really know how effective these measures will be. Scott Bessent said they will be, the toughest the world has ever seen, that sort of Trumpian sort of hyperbole. But there isn't a lot they can do. One of the problems is that China buys 90% of Iran's exports, particularly oil. And Trump is meeting with Xi Jinping, the Chinese leader, later this year. And he doesn't really want anything to mess that up. So Iran is already weighted down with more than 2,000 sanctions on its institutions, people, things like that. So they would have to turn to China and sort of punish China for that. But that's not really a sustainable strategy either because of the U.S.'s reliance on Chinese exports and his meeting with Xi Jinping coming up. So we're really sort of all mystified about what Scott Bessent is going to pull out of his top hat.
Bloomberg senior editor Benji Benjaminson there with the latest. Let's take a look at some of the other top global headlines that we're following this hour. And our top U.S. military commander has acknowledged that mental health is a valid concern aboard the USS Abraham Lincoln after an Iran war deployment of more than 200 days. Admiral Brad Cooper visited the Lincoln following reports about food shortages, contaminated water and mouldy conditions on board. The former Joint Chiefs of Staff chairman Mike Mullins says problems have been aggravated by port call challenges.
Those deployments are very, very difficult. Historically, we've been able to typically go to a port to take a break, do maintenance, and then come back online. Even back in Vietnam timeframe, we did that. The problem right now is in the AOR, the places we would do that, Bahrain, in the theater, Bahrain, or in the United Arab Emirates, those are targeted right now.
President Trump has directed the Pentagon to substantially reduce joint military exercises with South Korea while praising the North Korean leader, Kim Jong-un. Trump used social media to call the costly drills an inappropriate signal to North Korea, which he says is respectful towards the US. He also mentioned that South Korea is declining his request for support in the Iran war. Rescue teams in Indonesia are clearing landslides and reopening blocked roads after Saturday's earthquake off Flores Island killed more than 50 people. Emergency response operations are expected to continue for up to 3 weeks as military aircraft dispatch aid to remote areas. Some residents took shelter in a local football stadium as aftershocks continued on Sunday. More ahead here on the Asia Trade. This is Bloomberg.
Next week, Bloomberg is live at the Jackson Hole Economic Symposium. Tom Keene and Lisa Abramowitz, along with Michael McKee, will bring you news and interviews with Fed leaders, policymakers, and economists shaping global monetary policy. Tune in for continuing coverage and a special episode of Surveillance, August 28th at 9 a.m., including full coverage of Kevin Warsh's first speech to the conference. The Jackson Hole Economic Symposium on Bloomberg. Context changes everything.
Here's a quick check of some key economic events to be watching out for this week. Today, China's July activity data is due. It's expected to confirm the economy lost momentum ahead of a Politburo meeting that stopped short of introducing fresh stimulus. Japan's second quarter GDP numbers are also out today, Monday. Economists expect growth accelerated, strengthening the case for another BOJ rate hike. Bank Indonesia is widely expected to keep rates unchanged on Wednesday before investors turn their attention to the latest Fed minutes for clues on the US policy outlook. And Japan's July inflation report rounds out the week. That's expected to come in hotter than the previous print.
Well, China has delayed the release time for its July economic data from 10 a.m. to 3 p.m. local time. Instead, President Xi Jinping will deliver a speech this morning at a ceremony marking the 100th anniversary of the former President Jiang Zemin's birth. Let's bring our China correspondent Min Lo, who joins us in Hong Kong. Yeah, this is quite an unusual break from practice, right? Does it give us any indication of what the data might look like? We know that it's not likely to be impressive in any kind of significant way.
Yeah, we are expecting the data to confirm pretty lackluster growth in July, particularly because of bad weather as well. Don't forget, we had a couple of typhoons hitting China, so that also affected things like shipping and construction. So you look at the data breakdown, at least from economists' estimates, we're looking at retail sales improving slightly from the previous month, but that is the only metric that is seeing improvement according to forecasts. Everything else, whether it's industrial production, fixed asset investment, property investment, and even surveyed jobless rate, all expected to deteriorate. And fixed asset investment, we did see, for example, government spending contracting in the first half. It's expected to pick up in the second half, though, as the government continues to emphasize on these infrastructure investments, particularly in the so-called 6 networks, including things like data centers, logistics, telco systems, for example. But yes, when it comes to private investment, that remains pretty weak, right? Especially if you consider the credit data that came out over the weekend showing that people, that Chinese residents were paying back close to 600 billion yuan. So very weak credit data, and that is also showing up in bond yields as well, which is hitting, I think, a 1-year low at this point in time. So overall, not very positive when it comes to the data expectation.
I'm sure we'll all be very impressed by how unimpressive it is, but delaying the release time of that economic data. Quite a break from recent practice, really. So can you tell us more about this ceremony marking Jiang Zemin's birth? Is this unusual?
It is not necessarily unusual because China has a practice of commemorating the 100-year birth anniversary of some of its key leaders. So Mao Zedong had the ceremony, Deng Xiaoping also had one, and Jiang Zemin, since he is a major sort of leader, the 3rd generation leader of China, he is also receiving a ceremony. I would say, though, that this ceremony is a bit more low profile compared to the one that Deng Xiaoping had, because that was a month-long celebration that ended with that ceremony at the Great Hall of People, and former President Hu Jintao unveiled a statue of Deng Xiaoping in his hometown in Sichuan province. But this celebration of Jiang Zemin's birth is so far quite low profile. There has been some documentaries that has been aired on state media. They are releasing, for example, Jiang Zemin themed coins and postage stamps, and of course President Xi will be giving the speech later, and we already see some editorials coming out of state media like People's Daily over the weekend, really highlighting some of his key achievements. But it's also a way to use the elderly, the party elders, right, to rally the party together, because the editorial also talked about how it's important to have the party at the center, to have Xi Jinping thought on socialism as the guiding principle, and using a quote from Jiang Zemin about his belief about how the party really needs to be the center of leadership in China. So it's really using this as a way to bolster President Xi's leadership in the country as well.
All right, Bloomberg's China correspondent Min Lo there. Let's take a look at how we stand in terms of markets ahead of the open this Monday. We are anticipating a somewhat modest or softer open. The yen still hovering just below that 160 level. Not a lot of change there for the euro or the dollar. We do have a very interesting 20-year bond auction coming up this week as well out of the US. More ahead on the Asia trade. This is Bloomberg. Well, we're keeping a close eye on the Middle East again today. I mean, nominally an important day. The ceasefire between the US and Iran does expire, although what does it even mean at this point? We have had
ceasefire by any other name.
Pretty much. I mean, Israel has wasted no time. You see the pictures on your screen there, already renewing its attacks on Lebanon. But it's interesting what's happening in the Strait of Hormuz as well. oil's somehow getting through. There is a dark fleet. People are finding workarounds through pipelines, other methods as well. But on the weekend also we had President Trump saying he would declare the Strait of Hormuz territory of the US, and Iran just calls that a fanciful delusion.
It's quite interesting when you take a look at the dynamics in the oil market, because I know that we've been questioning why has the pass-through to inflation, why have oil prices more or less kind of held steady, right? And part of it is going to be what China is doing or not doing. We know that they're buying probably a share of Iranian oil. That's helping Iran, certainly, but also that they've cut over the last couple of months their usual oil imports by as much as half or even more. So there is that sort of demand destruction side of the story. And you can see Brent crude at the last trade up by just about 0.3%. We're pretty flat in New York traded crude session at the moment, and muted start to trading as we head into the new week.
Well, a lot of economies, of course, exposed to these high energy prices, and our next guest leads the Central Bank of Sri Lanka, which kept interest rates unchanged last month as renewed tensions between the US and Iran cast uncertainty over the global economic outlook. The central bank had surprised markets with a significant rate hike in May aimed at cooling credit growth. Governor Nandalal Weerasinghe is part of a Sri Lankan delegation visiting Australia this week to attract investors and joins us now right here in Sydney. Governor, welcome. Thank you so much for your time. I do want to start with the oil price issue. Can you talk to us about how vulnerable Sri Lanka is to these energy shocks?
Yeah, of course, Sri Lanka is exposed to this, especially because we are net energy importing country. We only have renewable energy like hydro, wind and solar. So that's dependent on thermal power is high and for transport. So as a result, we are seeing inflation was running around 2% somewhere until March, April. And all of a sudden, with the government policy of cost recovery pricing, domestic pricing, inflation shot up from 2% to 5% and now close to 7%, which is upper band of our central bank target limit. So it clearly says energy is an important component. Energy and transport has a very high weight in the consumer basket. As a result, always is vulnerable and basically exposed to high energy and transport prices.
Well, you have earlier declared that the accommodative policy is over. What kind of oil price do you need to see to give you some confidence that inflation is coming under control?
What we have predicted is that our baseline scenario is that if oil prices remaining around $80 a barrel for this end of towards this year and next, then we can manage the situation. So if there are any surprises, then obviously we have a challenge. So what we see, current projection of around 80% now is moving around that level. If it remains that level, I think we can manage inflation. We are expecting inflation to come down around our target level of 5% in, say, towards the end of this year and early next year.
Do you think that's an optimistic view? Because we had June 6.8%, July was 7.3%, 5%-ish is the target. Yeah. Do you think policy is restrictive enough at this point?
Yeah, because when you look at our tightening in May, it's very proactive and sharp, and it was a market surprise by the market by 100 basis points. We did that because we saw inflation was coming up, moving around 7% for a couple of months this year, especially towards the end of this year. So that was a proactive measure for us to contain. One is the anchor inflation expectation. Second, to slow down the credit growth is so expanding rapidly, and also to have any undue pass-through through persistent inflation from current high levels as a result of oil prices. So for that, all these things are tightening, in our view, was very proactive and good enough measure. That's why last time we did not revise the interest rate in the last cycle. But we are very closely monitoring the situation. Our prediction says it's gone down 5%, so that I think we think we have sufficient tightening. We also see, as a result, credit growth is now slowing down, and also currency is now fairly stable and gradually appreciating from the pressure we had in April and May as a result of very high oil imports. And as a result, now we are seeing a stabilizing situation as a result of partly the monetary policy measures that we had in May, and also some of the measures brought in by the government to curtail certain imports. For example, motor vehicle import, they have a surcharge imposed, and they have loan-to-value ratios are imposed by the central bank as a macroprudential measure. Now those policies are now working, as we can see now, going forward.
What about the growth outlook? Any risks
Growth,
there?
if you look at Sri Lanka has been growing around 5% for third consecutive year after the crisis. So very steady, stable growth around 5%. Even Q2 we see economy will be growing around 5%. There could be some slowdown in the second half, but still it could be around between 4 to 5% because the slowdown is expected because the tight monetary conditions as well as the high prices. This will have some impact on the growth, but it won't be very adverse because now things are settling down. We think this year second half may be around 4 to 5%. Then it will come back to more potential growth of 5% next year onwards.
Well, you're here in Australia for the Invest Sri Lanka events here in Sydney and Melbourne also. What's your message to investors here? Why should they be putting money into Sri Lanka?
I think when you look at the situation now, clearly after the crisis, economy is recovering nicely. Around 5% is a very good growth. And going forward also, the uncertainty and vulnerability that we saw, we have been able to manage the Middle East situation. And also we had the internal dicta, the cyclone had an impact, small impact. With all this kind of external shocks, we have been able to manage the situation well. So going forward now, it is a good time. The economy is recovering and now moving to high growth path. So for anyone to benefit for the future steady growth that we are seeing over the last 3 years and next couple of years, this is a time for anyone to come to Sri Lanka, and with currency stable and there's reasonable prudent macro policy, even fiscal policy, much more prudence now. As a result, the private sector growth backed by private investors are now, we can see realization. There's time for Sri Lanka, anyone to invest in Sri Lanka now.
How is Sri Lanka navigating the IMF program, given just the degree and magnitude of global uncertainty at the moment?
If you look at the program, we have been successfully completed the fourth and fifth review together in first quarter. Now this next review is somewhere in November, December. And we are expecting that also to be completed. And then next year, we will be completing 4-year Extended Fund Facility, fully completed program by the second half of next year. So it's going well. And IMF has recognized it's one of the case studies that Sri Lanka is one of the countries. The IMF backing and support has come out extremely well to stability and also medium to long-term growth.
Governor, really great to have you with us. We appreciate your time and best of luck with this trip in Australia. Nandalal Weerasinghe, who's a Sri Lankan central bank governor here in Sydney with us. Much more to come here on the Asia Trade. This is Bloomberg.
Japanese markets will open at the top of the next hour. We're looking at some modest upside for futures at the moment. Last week was a pretty good one for the Nikkei, better by 4.6%. The yen, though, continues to be a point of focus. 159.20 was the last trade there. We will get GDP numbers out for the second quarter today. The first quarter showed stronger real wages, quite a lot of resilience in the Japanese economy, but still, Bank of Japan not doing anything, really. Let's get to our chief Asia FX and rates correspondent, Ruth Carson. So, Ruth, the yen carry trades are alive and well despite the threat of intervention in Japan. What is positioning data telling us at the moment about the interest in these risky strategies?
Yeah, absolutely. Definitely alive and well in a $9.5 trillion a day foreign exchange market. The yen remains very popular to sell, not just among hedge funds or leveraged investors, but also asset managers through to your mum and pops in Japan. Positioning data for last week from the CFTC shows that after the big intervention, the joint intervention that we saw a couple of weeks ago, positions are still net short the yen. In other words, investors are still continuing to sell the yen, borrow the yen to invest in higher yielding assets. And that includes treasuries through to, your Brazilian bonds and all that. Just shy of 60,000 contracts net short on the yen. So again, this does put pressure on Japan's currency.
And where are we seeing the most enticing returns for hedge funds?
Yeah, absolutely. So remember, it is a risky strategy. It thrives in low vol environments. But when investors take a look at their books and look at rate differentials, they still matter. They're still juicy carry. So for example, if someone was to sell the yen against the Brazilian real, you get about a 15% return this year. That's fantastic. And I know that hedge funds that I've spoken with are also interested in currency like the Norwegian krone or the Aussie dollar, where you sell the yen against these currencies and you get more than 10% this year. So very easy pickings there as long as volatility stays low.
Bloomberg Chief Asia FX and Rates correspondent Ruth Carlson there in Singapore. Well, shareholder activists who've raked in profits in Japan over the past few years are moving into a more challenging phase now. They tangle with less compliant targets and more sceptical government stances. Let's talk more about this with Jamie Halse, who's the CEO at Senjin Capital. It's a Japan-focused shareholder activist, a fund manager. Jamie, really great to have you with us. And to be fair, there feels like there's a lot more sort of activism when it comes to pressuring the BOJ at the moment than perhaps corporate Japan. How do you define the stage that we're in?
So we've really seen three phases of shareholder activism in Japan. The first one was early 2000s, where you saw players like the Murakami funds come out, Steel Partners went into the market, a lot of hostile takeovers, kind of almost corporate raider type activity. There was a big backlash against that. And then with Abenomics starting back in 2013, we saw the second wave of shareholder activism come into the market, which is really about engagement, the government pushing the corporate governance code and the stewardship code to make domestic asset managers engage more, and foreign shareholder activists having this sort of constructive approach. From about 2021, 2022, we've entered into the third phase, which has then been supported by the Ministry of Economy, Trade and Industry's takeover guidelines and the Tokyo Stock Exchange becoming one of the biggest activists in the market. And I mean, pressure on the BOJ, yeah, that seems to be the currency markets putting pressure on the BOJ to raise rates at the short end. We've seen the long bonds close the gap, but the yen's just fundamentally extremely cheap. You only have to visit Tokyo and eat out at a lovely restaurant for dinner and compare the bill to what you get in Sydney to understand just how cheap the yen is.
Yeah. Always tempting us with a good time every time we do a yen check, right? But where's the pushback coming from? Is there a sense that maybe activism, at least in a short term, has reached a bit of a peak? Are we hearing a bit more from companies now?
Look, I kind of reject that framing. There has been some mild reforms at the government level, but really that's just bringing Japan into line with how Western markets operate. So just to set the scene, in Japan right now, a shareholder can basically propose anything they want to at a company's annual general meeting. They can direct a company to fire the CFO or fire the lunch lady if they want to. And one of the reforms being suggested is maybe shareholders shouldn't be able to propose resolutions around company operations, that they should be limited to resolutions that change the board. Is that reducing some rights for shareholders? Yes, but in practical terms, those resolutions never pass anyway. 99% of shareholder resolutions proposed at AGMs are voted down. That's not to say they're not effective. Often what happens is an activist will propose an increase in the dividend or a share buyback. The company will oppose that resolution. Shareholders won't vote for it, or only a third of shareholders or something will vote for it. But then after a decent face-saving interval, the company will often do a lot of what has been asked of them. So shareholders have had, activists have had a lot of success in Japan. There's a lot of money in the space now. As you sort of alluded to before, the targets are getting a little bit more challenging, particularly at the larger end. It's less obvious value, but still compared to other markets like the US, which is still the biggest market for activism globally, the opportunity in Japan is very early innings.
So how do you identify activist targets, and have the reforms changed the way that you identify them?
So the recent reforms have not changed anything for us. Like, there's no practical effect of any of the recent headlines in the news at all. We take quite a different approach. The established activists that have been around a long time have raised a lot of money. They're limited now to looking at much larger companies. We're looking at the small end, where you can still find companies that have cash, real estate, and investment securities worth a lot more than the company's current market valuation. So effectively, you get the business for free. So we're identifying the cheapest companies with hidden real estate on the books at historical cost. So they might have built a factory in central Tokyo 100 years ago, and that land is now zoned residential, but they're still operating this factory there, and they've never redeveloped it. So examples like that. And then we're looking for businesses with reasonable quality and reasonably stable cash flows. And really just that big undervaluation is key for us. And some initial signs of improving corporate governance are good as well. Has the company increased their dividend, done a share buyback, increased the independence of the board? But the real opportunity is you're buying something that is today worth a lot less in the public market than what it would sell for in the private market. So you know roughly what a private equity buyer would pay for this company. And there's just this massive discount because management does not focus on shareholder value.
Well, stocks held by activists have underperformed the broader topics in 2026. That's after 4 years of outperformance, however. What's the reason for this? Is it the AI boom or is it something else?
Look, I saw that stat that you quoted in the article, and it's a reasonable attempt to quantify activist performance. We looked at 300 stocks held by activists. What I will say is it's absolutely impossible to accurately calculate activist performance from publicly available data. You have no idea. Anything that's not a public position will not be caught there. There's some massive public positions that won't be caught. For example, Elliott's position in Qian is under the 5% threshold. No one knows exactly how much they hold. So start off, there's issues with that data and saying that they underperformed. But even on your data, you're saying it implies that activists delivered a 12% performance in the first 7 months of the year. That's pretty good. And activists are not holding the stocks that are driving the market, which have been the mega banks, AI-focused stocks. I would expect activist performance to be relatively uncorrelated to the broader market because they are targeting inefficient, older world companies. So you'd expect the returns to come through year after year after year, even if the market is down.
Jamie, really great to have you with us. Jamie Halse is the CEO and CIO at Senjin Capital. You can catch Japan Ahead every Monday at 8:40 a.m. If you're watching in Tokyo, subscribers can watch live on the terminal using the TV Go function. This is Bloomberg. We do have some breaking data when it comes to second quarter Japan GDP numbers coming through. 1.1% on an annualized basis. That is much less than expectations of 2% there. Let's break that down a little bit. We've got net imports adding 0.5 percentage point to that quarter-on-quarter number there. That was slightly better than expected. 0.3% quarter-on-quarter is the growth. Also missing expectations of 0.5% there. Private consumption was unchanged. Nominal GDP rose 1.2%. That was in line with expectations on a quarter-on-quarter basis. We saw a contraction in business spending of over 1%. The estimate was for a gain of 0.5% there. So that's quite an interesting read when it comes to what we're seeing with the growth picture, given that, of course, the pressure continues to build for the Bank of Japan to be a little bit more active there. We've seen the yen essentially unwinding around half of those gains that we've seen since that surprise intervention. But the GDP numbers really bucking expectations. We had been expecting a bit more robustness in that pace of growth in the second quarter, strengthening the case for the BOJ to hike early. That could potentially change the picture.
Well, let's check in on some of the stocks to watch when trade opens shortly in Australia. National Australia Bank's third quarter profits climbed as lending to businesses across the country expanded. Unaudited cash earnings coming in at $1.3 billion in the 3 months to June 30. A2 Milk's New Zealand shares have tumbled after full year net profit fell 44%. The company also warning of a sluggish second half as it struggles to win back Chinese infant formula customers due to supply chain issues. And Bluescope Steel has raised its underlying EBIT guidance for the first half to 960 million Australian dollars and is expected to issue a special dividend in the second half. Australia and New Zealand equities reporter Kamali Agana joins us now with more. So, Kamali, we're a few weeks deep now into earnings season in Australia. Are there any themes emerging so far?
Yes, so we're about a fifth of the way in. We're already starting to see a bit of read-through about the strength of the domestic economy and the local consumer. Last week we had CBA's full-year earnings, and we've also got quarterlies from Westpac, ANZ, and NAB, as you mentioned this morning. A big focus of the commentary there is the strength of the housing market. All of those banks have reported declines in their mortgage applications, so that's really starting to come through. We're going to get some more read-through about the domestic consumer as we get more earnings.
We had A2 Milk Bluescope coming through this morning. Key takeaways?
Yes, so unlike the banks, A2 Milk and Bluescope, their fortunes are more tied to the global economic outlook. As Paul mentioned, A2 Milk earnings that were a bit of a disappointment. Guidance for the 2027 fiscal year is a bit weaker than expected due to some of those issues with supply chains. Bluescope, that's been in the news in the first half of the year because of an M&A takeover that's sort of fallen through for now. But the read-through from analysts so far seems to be positive. Guidance for the next fiscal year is positive. That seems to be mainly driven by its US steel-making business, whilst the Australia business seems to be a bit mixed.
We've got a couple of heavyweights this week as well. Of course, BHP out, Santos as well. What can we expect from these results?
BHP will be a big focus for us. Copper is going to be a big thing to watch in terms of their earnings. Now, BHP and its peers Rio Tinto, Fortescue have rallied a lot this year because of the strength in copper prices as we look to the AI build-out and demand for that. But if you look at the last quarterly results that BHP reported, they've actually had a bit of softening in their copper volume. So that will definitely be a big focus. Santos will also be something to watch. It's benefited a lot from the higher oil prices from the Iran war. We need to be watching if those oil prices are feeding through into earnings.
Bloomberg's Australia and New Zealand equities reporter Kameli Agana there. Lots more earnings coverage out of Australia this week, as we just spoke about. We have Bluescope Steel CEO Tanya Archibald joining the China show a little bit later to talk through those latest results. Tomorrow on Insight, we'll be speaking with the BHP CEO Brandon Craig on the outlook for the mining giant. Let's take you through what we're expecting as we get the market open in just a few minutes' time here in Australia and of course in Japan as well. Of course, this is a picture as we look at a bit of downside for Sydney futures, about 1/4% lower there. Watching the oil price as well, holding on to gains, but really pretty muted trading as we continue to watch for any developments of what happens with the official expiry of that ceasefire, but also increased hostilities between Israel and Lebanon as well. Nikkei futures a little bit of upside, about 0.3%, and we're seeing some positivity when it comes to trading in US futures. Market opens in Sydney and Tokyo are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens, and a striking sense of a lack of volatility, particularly when you take a look at how this AI trade, AI financing just continues to barrel on, right, at a time where we're still contending with some of the downside issues. The fact that we're seeing these pressures in the long end of the bond market, the fact that we're seeing still the official expiry of the ceasefire, not that it really means anything at this point, given how fractured the relationship has become between the US and Iran, but we've got now tensions between Israel and Lebanon flaring up again. Markets seem quite sanguine at this point.
Well, I think they're used to this kind of thing by now.
Right.
You didn't even mention on the list President Trump saying, we're not sure about military drills with South Korea anymore, and North Korea is behaving
Don't
itself.
Be so hard on Kim Jong-un.
No, exactly.
Oh, what a way to start the week, right? But let's get you to the market start to the week as we come online. We do have a little bit of upside here with Japanese markets up by just about 0.1%. But I will point out some interesting implications for the Bank of Japan, given we just had a pretty sizable miss on that second quarter GDP number. That economic growth picture clearly taking a hit as we have the impact of the Middle East conflict continue to drag on. GDP, the annualized number, 1.1% in the second quarter, missing expectations expectations of around 2%, also slower than the revised 1.9% in the previous quarter. So a miss on just about every front. Another third consecutive expansion had been expected there, but certainly not to that degree. Really looking at the fact that we've seen the economy suffer from the conflict in the Middle East, fuel prices, products made with petroleum, for example. We also saw some disruption to supply chain. So all of that is going to play out. The big question with yen at 159, what are the implications for the Bank of Japan?
Yeah, and implications for other developed economies as well, because the US, of course, was deeply involved in that defence of the yen a couple of weeks ago. And there's a photo opportunity for anyone who's interested in New York this week. The debt clock for the United States is about to tick past $40 trillion. Now, we see yields rising here. We had that 30-year auction last week, which delivered the highest yields in 25 years. There's a 20-year auction this week, which is traditionally a tricky one. $16 billion worth of debt up for sale, an estimated yield of 5.27%. And that would be the highest since that 20-year note got reintroduced back in 2020. Take a look at crude prices as well. Well, they're not moving much because, as we were discussing earlier, the world seems to have got kind of used to this situation. The Iran-US ceasefire nominally expires today, but let's be honest, it's really been dead for quite some time, hasn't it? All right, joining us now is Homin Lee, Senior Macro Strategist at Lombard Odier. Homin, thank you so much, as always, for your time today. And I do want to start with that Japan story. We just got that second quarter GDP data. Anemic would be perhaps the best word if I was to choose one to describe it. Does this give you a bit of confidence in ongoing yen weakness on the assumption the Bank of Japan's now got an excuse to keep doing nothing? Is the carry trade alive and well?
Well, we would push back a bit against the idea that 1.1% quarter-on-quarter is an anemic number for an economy like Japan. In fact, the 2.0% consensus might have been a little too aggressive, especially in the quarter when we had the full impact of energy market disruptions. The bottom line is that we have a positive growth, and it's entirely possible that given the history of revisions in the Japan's economic real GDP data, after capex numbers come out from the Ministry of Finance, you could actually see a bit of upgrade. And this positive growth is good enough, in our view, for the Bank of Japan to still consider some additional rate hikes. And if you look at the deflator series for the same release, in fact, it was above consensus, right? So we do have this underlying inflation, and of course, in the context of a fairly weak yen. So we still think it's quite likely for the Bank of Japan to actually try to lean against some aggressive carry trade by raising short-term rates. And also, we don't rule out the possibility of the BOJ bringing forward their tightening plans for the remainder of the year. And the joint intervention that you mentioned, in fact, raises the stake for the policymakers to consider that kind of a yen-supporting measure in the remainder of the year.
All that said, you are overweight Japan. Are there any particular sectors that you're looking at, or is it just all about the AI story right now?
Well, AI is certainly a key theme for the Japanese equity market, but also industrials and materials. Basically, you have the cyclical sector in the Japanese equity market, firing on all cylinders, and that's actually quite normal to expect this kind of outcome in a global cyclical boom, given the market's usual sensitivity and a high operating leverage. So even if there is a bit of setback on rates front and the dollar-yen front, and certainly for the latter, we don't expect a major appreciation from here, even if the BOJ raises rates a bit, given the undemanding valuation and fairly good setup for the earnings outlook, we think the broad market will perform pretty well. But if you really have to delve into the sectors, financials, some industrials and materials, I think these sectors are quite nicely positioned for the remainder of the year, and of course the AI theme.
Homin, staying with the AI theme, I know that you're constructive when it comes to South Korea, when it comes to China, as well as not underweight with the US. So how are you kind of splitting where you see those opportunities? Because we've seen the disruptive force of China really continuing to make leaps and bounds. Is there better value there for the AI plays versus the sort of more Western-oriented markets?
So we think the debate in terms of the competition between the U.S. Tech stack and China tech stack will not be resolved in any time soon, simply because there is significant amount of uncertainty surrounding that debate. But given what has happened so far and the steady progress in technology that we see in the China tech stack, we think it's worth having it as a hedge in the portfolio, in a diversified portfolio setting, having a bit of exposure to Chinese equities, especially with this very cheap valuation of forward multiples around maybe slightly below 11 times for the offshore listings. It's worth having it at least as a hedge. So in case there are some unexpected significant innovation and advancements in the China ecosystem, you can benefit from that. For the US, our position is neutral. The hyperscaler free cash flows and the financing debates, they're certainly not going away anytime soon. But the software sector is performing pretty well, and we still like that sector. And finally, for South Korea, memory still remains the bottleneck. Jevons paradox still valid for the dynamic between price and volume. So with this calming down of volatility related to leverage positions among retail investors, we think it's actually worth having that exposure as one of the preferred exposures within the emerging market equity allocation.
Markets at this point are pretty happy to kind of shrug off the risks, right? Namely, the macro weakness that we're still expecting out of China. We've got the domestic activity numbers coming through this week, as well as obviously the lack of resolution in the Middle East and what happens with oil prices. Are these sizable risks to the downside?
These are risk factors that we need to live with, and of course we have to be vigilant about them, but it really comes down to the conviction about how these risks will actually affect the markets for the remainder of the year. And if you think about the Middle East conflict, the rhythm of a sporadic flare-ups followed by a period of calm, that's basically been the situation for the region. And we still think there is a very strong political incentive for both sides to basically maintain that framework despite very harsh rhetoric. And for the China data, we're going to get the July data, and it's entirely possible that it's a bit of disappointment. But if you think about the fiscal policy and the underutilized resources that has to be implemented more aggressively for the remainder of the year, we still think the likely outcome for Chinese economy for the remainder of the year is that of a rebound. And so that really leaves, especially for the emerging markets and the broader risk asset class, the key factor actually could be the Fed policy. But for that, again, there is a debate. We're siding with the extended pause view here. And if we are right in that prognosis, then the risk assets could actually continue to grind up for the remainder of the year. And that's the reason why we maintain our pro-risk tilt in our portfolios.
Homin Lee, always great to have you with us, Senior Macro Strategist at Lombard Odier. Let's take a look at some of the stocks that we are watching at the moment, particularly when it comes to the earnings-related names here in Australia. NAB, the third quarter profit climbing. Business credit growth remains robust across the business units that we're watching at the moment. We are seeing downside, though. CEO Andrew Irvine says the slowing housing market is threatening to eat into profitability. We're also watching A2 Milk's full-year net profit tumbling 44%, flagging a sluggish second half as it struggles to win back Chinese infant formula customers due to supply chain issues. Bluescope Steel is the other one that's a major today, raising its underlying EBIT guidance for the first half year to 960 million Aussie dollars, forecasting a special dividend of 70 cents per share in the second half.
We've got plenty more earnings coverage out of Australia this week. Bluescope Steel CEO Tanya Archibald is going to join the China show later to discuss the company's latest results. And tomorrow on Insights, we'll speak with BHP CEO Brandon Craig about the outlook for the mining giant. More ahead on the Asia trade. This is Bloomberg.
Jackson Hole Economic Symposium. Tom Qian and Lisa Abramowitz, along with Michael McKee, will bring you news and interviews with Fed leaders, policymakers, and economists shaping global monetary policy. Tune in for continuing coverage and a special episode of Surveillance, August 28th at 9 a.m., including full coverage of Kevin Warsh's first speech to the conference. The Jackson Hole Economic Symposium on Bloomberg. Context changes everything.
We're keeping an eye on risk assets after Lebanon had its deadliest day of Israeli attacks in months, the escalation heaping pressure on stalled US-Iran negotiations, while Washington prepares fresh sanctions against Tehran. For more, let's get to Bloomberg's John Herskovits. So, John, the US says it plans to roll out an economic isolation plan for Iran this week. What details do we know?
Yeah, so far the U.S. hasn't given any details of what would be in the plan. Now, this comes as Iran is already facing a naval blockade. It has about 2,000 or more sanctions on it. So the economic pressure is there. The key for this plan is whether it actually goes after the people who help finance Iran's trade and buy its oil. And the biggest purchaser of Iran's oil is China. If the U.S. tries to target Chinese banks that help finance Iran, the U.S. risks trade conflict, economic conflict, and political conflict with Beijing. And this could also increase oil prices and make the global economy more difficult. So we have to see whether the plan is going to actually target those who do the trade, or if it's just going to be something for show, something that lists hundreds of shell companies and tankers, a really impressive list with a lot of names that doesn't really affect those who do trade. So we haven't seen it. It's supposed to come this week, and the key is how much it affects China or how much it just affects a long list of shell companies and tankers.
John, in the meantime, we're seeing the proxy fighting resume again with Israel's strikes on Lebanon. How does this play into the further complicating the situation?
Sure. We've seen the deadliest fighting in Lebanon in months. I think 11 people were killed, including a senior Hezbollah commander. This is periphery to the overall deal between the U.S. and Iran. This is something that's key for Iran, seeing a ceasefire here as part of the overall ceasefire. So if these tensions flare up, it makes it more difficult for a broader deal to go forward. Trump's son-in-law, Jared Kushner, has held talks. I believe he's going to hold talks in Israel this week, but this is mostly focused on Gaza and Hamas. So I'm sure Hezbollah is going to come up and Lebanon will come up, but it's another point of friction for the overall situation. So it's flared up and it's making things more difficult.
John, President Trump also scolded South Korea for not helping the U.S. denuclearize Iran. He also called for curtailing military drills with South Korea. What would the impact of this move be?
Yeah, it really affects the U.S.'s ability to provide security in the region. The U.S. and South Korea have been having military drills for decades, 70 years since the end of the Korean War. These drills help prepare the U.S. in the event of an attack from North Korea. And Trump has often gone after the cost. During his first administration, he curtailed these drills to help his nuclear talks with North Korea, didn't help with the nuclear talks. But the drills cost, I think the estimates at the time were between $10 and $20 million. But the thing is, these are essential for getting the U.S. and South Korea on the same page in the event of a North Korean attack. North Korea has hundreds, more or maybe thousands of missiles, artillery shells that it can pour into South Korea. U.S. Troops usually deploy to South Korea on one-year rotations. So having these drills is essential for U.S. military preparedness and knowledge up and down the chain of command and in the event of any contingency with North Korea. So really important for the region, and these have been a cornerstone of the security arrangement with South Korea for decades.
Great, Bloomberg's John Herskovitz there. Well, Middle Eastern oil producers continue to press ahead with shuttling large volumes of crude out of the Persian Gulf, helping keep a lid on prices even as the Iran war drags on. For more, Bloomberg's Dan Murtagh joins us. So, Dan, how is this working? How is oil making it through this, well, dual blockade?
What's happening is oil tankers are staying darker for longer. And by that I mean they have these AIS sponsors on their ships that kind of track through, geocoding where exactly they are. That helps in normal times for navigation. It's important for insurance. But in these times, they're turning those transponders off, and they're just disappearing off of the satellite maps. Then they'll show up 10 days later. We don't know if they've gone back and forth across Hormuz, 4 times since then, shuttling little bits of oil out to ships that are waiting on the outside. And so there's this big gap in knowledge for traders and buyers and sellers on exactly how much is making it through. People have been estimating about 4 million barrels a day, only a fifth of what had been going through before the war. Last week, the U.S. Energy Secretary Chris Wright said it was 9 million barrels a day had been going through that week. And so we're trying to recalibrate and trying to figure out what is going on in this dark space where there's no data and these ships are shuttling oil across.
Dan, there's so much to unpick here because I'm also quite curious as to what's going on with what China is doing, right? I was looking at the data that they've been really drastically cutting their oil imports over the past few months, so there's demand destruction there. Do we know what's happening with that and also how much they might be buying from Iran?
Yeah, China is still a buyer of Iranian oil. The big state-owned companies stay away from it because they don't want the secondary sanctions. But the teapot refineries in Shandong have always been Iran's sort of buyer of last resort. They'll buy Iranian crude whenever prices are low enough. Right now what's happening in China is a couple of different things. One is they've drastically changed their stockpiling. They used to be buying 1 to 2 million barrels a day above what they needed just to put in stockpiles. They've stopped doing that with these higher prices, and it looks like they're also pulling out from at least commercial stockpiles, and so eating into some of the commercial tanks, if not yet the strategic tanks that they've built up over the past decades. And so that's allowed them to reduce buying. And then there's also just demand destruction on the ground here. We've seen an uptick in purchases of electric trucks. EVs have been huge for the last couple of years. When oil and gasoline prices and diesel prices get higher, Chinese consumers have the ability for a bit more demand flexibility than a lot of countries that are just basically stuck with gasoline. And so we've seen, petrochemical firms have stopped buying. We've seen a little bit of demand destruction on the road. And so they've really dramatically reduced by millions of barrels a day how much they're importing.
Bloomberg's Dan Murtagh there with the latest. Let's take a look at another story that we're following when it comes to the geopolitical space. And a top US military commander has acknowledged that mental health is a valid concern aboard the USS Abraham Lincoln after an Iran war deployment of more than 200 days. Admiral Brad Cooper visited the Lincoln following reports about food shortages, contaminated water and mouldy conditions on board. Former Joint Chiefs of Staff Chairman Mike Mullen says the problems have been aggravated by port call challenges.
Those deployments are very, very difficult. Historically, we've been able to typically go to a port to take a break, do maintenance, and then come back online. Even back in Vietnam timeframe, we did that. The problem right now is in the AOR, the places we would do that, Bahrain, in the theater, Bahrain, or in the United Arab Emirates, those are targeted right now.
More ahead here on the Asia Trade. This is Bloomberg. Australia's richest person, Gina Rinehart, has revealed an almost $1.4 billion stake in SpaceX, making the rocket maker her largest investment. Bloomberg's global business reporter Angus Whitley joins us now with more. So tell us more, because along with Gina, of course, a lot of retail investors in Australia have exposure to SpaceX. It's not been the investment that they probably had been hoping for at debut.
That's right. It was a hotly contested IPO, wasn't it? Huge demand for those shares. And we knew that Gina Rinehart had been allocated some of those shares. We didn't know quite how much. So that was what came out over the weekend in a regulatory filing. She had 8 million SpaceX shares, currently worth just over $1 billion US. And you're right, first few days of that listing, they soared, didn't they? Then they've gone below the offer price. They're round about the offer price or just over at the moment. So I think the significance of that stake was that it's now her single biggest position, or at least Hancock Prospecting's single biggest position, which is her investment vehicle, and outside of her iron ore assets, of course. And previously that was MP Materials, which is the US rare earths producer. So it highlights her commitment to that company. And also we knew that she was a fan of Elon Musk. She'd previously made that no secret, but she doubled down on that at the weekend, her company releasing a statement describing Musk as an exceptional and brilliant person who can use science for the betterment of mankind. So not holding back in that regard. I think the other couple of things that were interesting from this filing was that Rinehart doubled her exposure in sort of small stakes, but necessarily still significant. So she doubled her holding in Trump's technology company, Trump Media and Technology Group. And I would group that exposure in a sort of handful of small stakes that are run by famous billionaires. So equally, Fox Corp, she bought more shares in Fox Corp. She also owns stakes in Tesla, Meta, and Amazon, all significant companies that are run by billionaires.
Yeah, so a lot of interesting reading in that disclosure. Does it tell us anything about her investing preferences and perhaps even Gina Rinehart's political leanings?
Well, you could argue, I suppose, that you can make your own conclusions about what it means to buy more shares in Trump's technology group, and Elon Musk political allegiances are well documented as well. I think one thing that's clear is beyond all the fanfare of buying a stake in Elon Musk's SpaceX and making that your single biggest exposure is also she's evidently quite a measured investor as well. For instance, her company bought more shares in ETFs, and her second biggest holding is a NASDAQ 100 sort of tracking ETF, and that's worth almost $1 billion US, and there's a couple of other big ETFs that track the S&P 500. So it's quite a measured portfolio. But broadly speaking, this is still 5 or 6 billion US. She is Australia's richest person. She's worth more than 32 billion US, so still a small chunk of her fortune.
All right, good context. That's Bloomberg's global business reporter, Angus Whitley there. Let's take a look at US cross-asset at the moment. Not a lot of change in the US dollar right now. NASDAQ futures better by about 1/5%. And on the tech front, we've just had the news that Alphabet is considering its first Australian dollar bond as its debt for AI starts to pile up. The US firm may sell those notes across 4 maturities, including as long as 20 years. This is according to an emailed statement from Australia New Zealand Banking Group, which is one of the 4 big banks in this part of the world. So Alphabet hiring banks for what would be a debut offering of those Aussie dollar bonds. We have more ahead on the Asia trade. This is Bloomberg. Got some breaking news out of Singapore. It is non-oil domestic exports, and a pretty chunky increase here, a rising 24.2% on year. That was a little bit slower than the expected 26.5%. When we break it out, though, electronics exports, a big spike, as you might expect, up 112% on year, and that was an acceleration of the more than doubling that we saw back in June. Top markets for those exports, the US, China, South Korea and Taiwan. Non-oil related re-exports, meanwhile, also saw a very big jump, and it was computer peripherals and parts of PCs that saw the biggest increase there, 262.4%. So another big spike in Singaporean non-domestic oil exports. Haidi.
Yeah, we're also watching what's going on in Japan, because that second quarter GDP number was a bit of a surprise, certainly unexpected. We saw capital spending shrinking banking. That was a big part of the story as we saw the 3 months through to June coming through with a disappointing growth number. The uncertainties in the Middle East, some of the disruptions on the supply chain front, the cost of petroleum and oil-related products as well. 1.1% was that annualized basis for real GDP growth. Expectations were around 2%. And to that point, CapEx deepening to 1.2% as a decline. Private consumption also flat, so that missed the estimate for a more modest increase. So whether or not this kind of weighs into what the Bank of Japan does or when it finally does it is the big question. 159 is where we're trading when it comes to dollar yen at the moment, and a bit of upside for equities in Japan at this point. For more, let's bring our Japan economy and government editor Paul Jackson. So, Paul, I mean, it's still growth. It's still 1.1% growth, right? So does this move the needle when it comes to what the Bank of Japan would be thinking?
Well, does it mean that they're going to delay their rate hike? I don't think so. I don't think it's a weak enough result for that. But it is a little concerning. I think this 1.1% figure kind of overstates the amount of growth. It's kind of helped by a slightly distorted trade figure that is mainly a factor of lower imports through the Middle East tensions. And that's one of the main factors lifting the growth this time round. If you look at the other figures that are key to the kind of domestic growth story, then the figures are a lot less flattering, a little concerning. We've got flat consumption. That's the private consumption. That's the weakest figure in a couple of years, and it kind of speaks to the people still struggling with inflation, having difficulty dealing with these price increases. This is one of the key things that Prime Minister Takaichi needs to remedy to get her approval ratings back on track after she's been seen spending too much time on pet policies. We do have this sales tax cut coming up, but that's not going to take impact until next April, so there's kind of quite a gap there. Also, we're seeing firms actually cutting back on spending. They were supposed to increase after cutting back in the previous quarter, so that's another cause for concern. Those capital spending figures from firms do tend to get revised quite a bit, so maybe we shouldn't place too much emphasis on that, but I think certainly that private consumption figure is alarming for policymakers going forward.
We haven't seen a great deal of reaction in the yen. In fact, it's got a little bit stronger. So what's the direction of travel for the currency now if the Bank of Japan continues to delay its tightening? Are we potentially going to see some more intervention to keep a lid on the currency?
Well, I think they will have to go ahead with this early term rate hike. I mean, you've had joint intervention with the US. That's really ramped up expectations, both here and stateside, that there's going to be some kind of rate hike. We've got 80% in markets. If you look at overnight swaps, pricing in of a rate hike in September, I think it's going to be very difficult to kind of turn back the optics and wait till December at this point. And like you said, right from the top, it's still growth, still over 1%. So it's not going to turn the needle on that.
Bloomberg Japan economy and government editor Paul Jackson. Joining us now is Qian Wang, who's a chief APAC economist at Vanguard. Qian, really great to have you with us. So what do you think? Are these numbers weak enough to kind of cast doubt over at least the timing for the Bank of Japan?
Heidi, thanks for having me, and Paul. I think when we look at the economic growth number, I think there are two things I want to highlight. One, at 1.1%, this is actually above potential growth, right, for Japan. So, I think recently we saw BOJ revise the output gap data and was showing that the Japanese economy, the output gap, it has remained positive ever since 2022. So this actually continued to, make the output gap larger, and that will continue to exert inflation pressure. And second, I want to highlight in the GDP report is that GDP deflator, right, actually increased further compared to the first quarter, and now 2.6%. So I think that actually shows you inflation pressure is really building up in the economy. Frankly speaking, I think for BOJ at this moment, the rate hike is not just an inflation consideration. It's actually more than that. It's a policy credibility, right? You have an economy grow, above potential, upward gap positive, inflation above target, and risk on the upside. And plus, the government is actually going to announce more fiscal, support to the economy. I think the question is for BOJ, instead of creating more inflation, now the question is, can they actually manage the consequence?
Yeah, a couple of things to pick out of those numbers that I thought was interesting. Consumer spending, private consumption was quite weak, and capital spending and investment was quite weak as well. What does this tell you about sentiment, and I guess how much that impacts the desire to obviously get the virtuous cycle going?
Yeah. I think, from a consumer side, I think, Japanese consumer has been, always cautious, especially given this higher food prices, energy prices. Actually, real wage growth only turned positive, right, this year. So I think it's some of the caution in there, I think, is understandable. But further down the road, I think, when real wage growth start to, continue to remain in the positive side, I think consumers should feel more confident, especially also with this kind of wealth effect, given the equity market performance. On the corporate side, I think if we look at the Tancom survey, right, the outlook is definitely positive, right? BOJ Tancom survey was showing that CapEx plan is rising at a double-digit pace. When facing this kind of a structural labor shortage, corporate have to make more investment, labor-saving investment. So I think it's just a matter of time. When we look forward, I think corporate investment should be able to pick up, further down the road. And plus, there's fiscal stimulus, right? Consumption tax cut, that is going to help consumption. And then strategic investment, as promised by the government, they are also going to, support domestic demand as well. So I'm not pessimistic. I think, Japanese economy should continue to grow and, well supported by domestic demand.
Qian, we've also got some data coming out of China today, of course, industrial production, retail numbers as well. In terms of the retail sales, I mean, there's a lot of AI spending, a lot of investment happening in China at the moment, but it doesn't seem to be really passing through in terms of inflation, better wages, increased demand. What's going to break the Chinese consumer out of their pessimistic attitude?
Yeah, I think, Paul, when you look at the Chinese economy, obviously the AI, advanced manufacturing, including a lot of the green transition, right, related production, they are the bright spot of the economy. But they are just number one, they are too small, right? To lift up the whole economy, right? When you think about the size of the housing sector, right, and others. And the second is also that those kind of advanced manufacturing is very capital intensive. They don't create a lot of jobs, right? To lift up the consumption. So, when you look at the consumers, I think there's still a lot of precocious saving incentive, right? Social welfare network need to continue to be improved. Consumers need to be more confident about the job outlook and also income growth, and also housing market need to stabilize for people to feel that there's no longer negative wealth effect. So I think there's a lot to be done before consumers feel confident to start to spend more.
Yeah, it's not just the consumer as well. We've got very weak credit demand out of China also. We do have a chart on the Bloomberg terminal that illustrates this. How long do you see this state of affairs enduring?
Yeah, I think when you look at the credit demand, it's pretty weak, right? The weak TSF, total social financing, was actually pretty, holding up well, largely because of the government bond issuance, right? So, but on the other hand, when you look at the private side, new loan creation for both household and also corporate actually contracted, right? So I think that's basically telling you how weak the private sector confidence and demand is at this moment. I think for the Chinese economy growth outlook in the second half, there are two things. One, can the government actually accelerate the deployment of the fiscal support, right? They have a lot of fiscal space, but then the question is, can they actually accelerate the implementation? And the second one is also whether exports can hold up because this is really the primary growth driver. But trade tension is likely to accelerate not just with the U.S. but with a lot of other economy as well. So if China economy only rely on exports, that growth model is unsustainable.
I wanted to ask about the impact of obviously what is, the expansive AI space in China at the moment. Do we continue to see that K-shaped recovery, or do you anticipate a point where that side of inflation, as well as the trickle-down impact of the AI space, starts to have an impact on the broader economy? By extension, do you also see that inflation factor in across the rest of the region? Because I know, for example, with the UK CPI numbers, we're expecting to see that chip inflation impact come through.
Mm-hmm. Yeah, I think when we look at the AI investment, I look at both Chinese economy and, American, right, how much they spend on AI. The spending from China on AI is actually much less compared to, what we saw in the US, right? I think part of that is a lot of the existing infrastructure, right? China has a lot of power network infrastructure, digital system, there. So they don't need to spend so much on it. On the other hand, China's, AI model is also much more efficient, right, compared to the US. So I think the absolute amount of AI investment, both by private sector and public sector, coming together is actually not, as large as what we saw in the U.S. And the second one is, how do we think that's, generating inflation pressure or deflation pressure? I think in the near term, you could see some inflation pressure, right? There's more demand for AI-related products. That actually is going to spill over to some consumer goods, like higher demand for chips, and then iPhone, for example, right? Cell phone price could go up. But on the other hand, I think if we look into the more medium to long term, China has a remarkable capability to produce everything, almost everything cheaper, with quality good enough for mass production and adoption. So from a longer perspective, I think China is still, going to, export disinflationary or deflation actually to the rest of the world.
All right, Qian Wang, Chief APAC Economist at Vanguard. Thanks so much for your time today. We have more ahead on the Asia trade. This is Bloomberg.
Well, rescue teams in Indonesia are clearing landslides and reopening blocked roads as the death toll from a powerful earthquake in the east of the country climbs to 53. You're taking a look at live pictures at the moment showing just the extent of the destruction at the Manggarai Regency in East Nusa Tenggara province. Our Chief Asia correspondent Rosalind Matheson joins us now with more. So, Ros, what do we know in terms of the extent of the damage and how rescue and recovery efforts might be underway at the moment?
Well, as you were saying, this was an earthquake 7.7 magnitude which struck off the island of Flores on Saturday. We did have aftershocks recorded on Sunday. There was a tsunami warning that was later lifted, but as that footage is showing, you've also had damage to property. You've had landslides that have cut off roads. We know that at least 50 people have lost their lives, and local officials are saying that the recovery efforts here are going to take at least 2 to 3 weeks. It's in a very remote part of Indonesia in the Far East. The government federally is going to send in aid. They're sending in that via military aircraft. They're also sending in military personnel to help. But Jakarta, the capital of Indonesia, is 1,000 miles from where this earthquake hit, which gives you a sense of just how big this country is, and very disaster prone. Of course, Indonesia sits on the Ring of Fire, which is this series of the borders of tectonic plates, and that makes it very prone to things like earthquakes, to volcanic eruptions, which we do see happen from time to time in Indonesia as well, also very prone to things like flooding and forest fires. So again, another challenge for the government here in terms of disaster relief and long-term resilience for Indonesia in the face of these challenges. But this particular disaster, there's weeks of effort here that's going to have to come in terms of rebuilding and recovery.
Yeah, and Ros, in terms of long-term resilience and rebuild and recovery, as you say, Indonesia no stranger to severe earthquakes, but so much of these death tolls are caused by collapsed buildings that simply can't withstand the intensity of the shaking. What's the path ahead?
Well, that's a big question for Indonesia. We saw, in fact, quite severe flooding late last year in Sumatra, for example, that caused landslides, a lot of damage, and again, not just to land, but also to structures. And Indonesia is quite quick to get disaster relief in these cases, often using the military, often using the police as well to facilitate moving stuff by aircraft, helicopter and plane as well. But the question is, what do you do to go beyond that in terms of long-term resilience? There are questions still about the Sumatra floods and whether deforestation, for example, contributed to that, whether land management contributed to that, the use of land and land permits that were granted in that area. So there are fundamental questions around land management as well as structural management, resilience of buildings. And those are questions, for the Indonesian government in all of this, because again, we see quite quick responses in the minute, but in an area that's very prone to disasters, that, some questions that will probably come again about what are the long-term plans here for resiliency.
All right, Bloomberg Chief Asia correspondent Rosalind Matheson there. We have more ahead on the Asia trade. This is Bloomberg.
We are looking ahead to another busy week when it comes to Chinese tech earnings this time. Investors will be looking for updates on AI spending, of course, profitability from Alibaba, Baidu and Kuaishou after rising investment costs weighed on Tencent shares last week. Analysts are expecting Alibaba to post its fastest revenue growth in 2 years. That'll be helped along by stronger cloud and AI demand. Baidu's earnings are expected to fall, though, to a 6-year low as AI competition pressures its advertising business. Xiaomi is another one we haven't mentioned yet, but that is one to watch. Analysts are expecting earnings growth to slow as investors scrutinise profitability in its EV business as well as the smartphone margins. Well, as earnings keep coming through thick and fast here in Asia, we'll also be speaking a little bit later this week to the HKX CEO, Bonnie Chan. The AIA CFO, Garth Jones, will be along with us, as well as Andrew Fung, who's a Henderson Land CFO.
Chinese and Taiwanese markets will be pricing further progress on the tech front when trading begins later. Anthony Stevens is back with us for a preview. So, Anthony, Alibaba, Zhipu, both making waves with their new models. Can you tell us a bit more about China's progress on LLMs?
Well, it's interesting to see Alibaba, top the list in terms of building the framework for open weight models. So it's the most downloaded open weight model now, pulling ahead of the American competition quite significantly. And that kind of headline did raise the ADRs overnight. ADRs are trading at a pretty healthy premium coming into today's session. And that just highlights the progress that China has made on the open weight way of doing AI. These models are getting more adopted in the US, even as they are obviously very popular in China. So that's something to watch. On Z.AI's front, they position their latest model update as making progress on cybersecurity, which is obviously becoming a much bigger part of the decision-making calculus going forward. How safe are these models to release into the world? And it's very interesting to see a Chinese player address that. Of course, you must remember that the Chinese open weight model was actually used to rein in some of the open AI kind of models that went a little bit haywire and resulted in a cyber attack. So this space is very rapidly evolving, and it'll be interesting to see how China's LLMs progress. Now, in putting this in the macro context, right, you saw China's new loans slow sharply again. So the credit demand for China for anything outside AI is quite constrained, and that's why you're seeing this huge demand for anything AI with related to new listings or new debt or even post-earnings is such a big focus, because that's literally the only thing in China that is posting strong growth and is attracting capital.
Taiwan posted GDP numbers. Taiwan dollars rallying finally ahead of export data this week as well. So the growth surge in Taiwan, how are we expecting that to play out in stocks?
Yeah, it's the other shoe on the foot, right? Away from the LLMs, it's Taiwan is producing literally everything that goes into the AI supply chain, and that's starting to show through in FX strength. Now, FX has been weak on the way up because foreigners were selling Taiwan because they had too much TSMC and too much MediaTek, and that foreign selling in equities has abated somewhat. So foreigners have been were large buyers last week, and that helped to push the Taiwan dollar stronger. And Taiwan dollar is on the 50-day moving average now. Risk reversals and forward points are indicating further strength, and Taiwan's export numbers come out later in the week, which are looking to be a 50% plus growth number, which is just incredible, right? And over the weekend and into the weekend, they guided their GDP higher to a double-figure GDP growth, which is an incredible number for a developed economy. So in terms of a macroeconomic picture, Taiwan is in a very healthy place. They're thinking about increasing their minimum wage, which is nice to see on the broadening out of the economy. And then in the micro, underneath TSMC, Taiwan is giving birth to some real superstars. You're seeing multiple names in the TWSC below the TSMC weighting, which are up 300, 400, 500% year to date. So people are really busy chasing alpha in Taiwan, and we're probably going to see more of that today as the Japanese players in these spaces are quite strong today, while TSMC has pretty muted leads coming into today's session.
Bloomberg Markets reporter Anthony Stevens. Let's take a look at what we're watching when it comes to the start of trading in Greater China today. The lead through from the US on Friday, we had the Nasdaq Golden Dragon Index rising over 0.5% on Friday, despite an overall fall in broader markets, of course. We are, as we mentioned, looking at a lot of the tech and AI names to look for the pressure on AI spending and the return on profitability as well. Defense stocks could also be in focus, given that President Trump said that he directed the Pentagon to substantially reduce those joint military exercises with South Korea. We're also seeing Japan's defense minister visiting a controversial shrine as well. So watching for some of those geopolitical implications there. Renewables are another sector to focus after a report that they're accelerating new rules governing reuse of wind and solar in China. That is it for the Asia trade. Our markets coverage continues. The China Show is next.